Today, we are looking at a crime scene. But it's not a murder, or at least not a murder of a person. It's the murder of a narrative.
That's a powerful way to put it.
It is Saturday, January 31st, 2026. And if you've checked the markets in the last 24 hours, you know exactly what I'm talking about. You've seen the red. You've seen the absolute panic.
A sea of red.
Silver just experienced its most violent sell-off since, what, the 2008 financial crisis?
It's Lehman Brothers. It was absolute liquidation. There's really no other word for it.
And gold. Trillions in market capitalization just gone, wiped out in a matter of hours.
Vanished into thin air.
And here's the thing that I just can't wrap my head around, and this is really the core mystery we need to solve today.
Go on.
The world is, objectively a mess right now. We have the chaos in Venezuela we discussed last week. We have supply chains snapping left and right.
Constant disruptions.
Exactly. By every traditional metric, this is buy gold weather. This is when you run to the bunker. But yesterday, the people in the bunker got shelled. Why? Why did the ultimate safe haven asset collapse at the exact moment the world got scarier?
That is the paradox, isn't it?
Yeah.
Usually fear drives gold up. Yesterday, fear drove it off a cliff. But to understand why, you have to realize that what we saw wasn't a natural market reaction. It was a staged crash.
Okay, staged. That word implies a director. It implies intent. Are we talking about a conspiracy here? Because we usually try to stay away from the tinfoil hat stuff unless there's some really hard evidence.
No, not a conspiracy in that sense. Not men in a smoke-filled room pressing a big red dump button.
Okay, good.
Think of staged, more like theater architecture. The stage was built in a very specific way. You had overcrowded positioning, massive amounts of leverage, and this very, very specific psychological reliance on the Federal Reserve. The architecture itself made the collapse almost inevitable. The news was just. It was the gust of wind that knocked the whole house of cards over.
Okay, so the house of cards was the debasement trade. Let's set the table for anyone listening who hasn't been glued to the ticker. Before yesterday, gold was what, nearing $5,000? Silver hit $120.
Unbelievable levels, yeah.
Why were we so high to begin with? I remember just a few years ago thinking $2,000 gold was expensive.
It feels like a lifetime ago, doesn't it? But you have to remember the context of the last 2 years. The primary driver, the engine behind that whole rally, has been the debasement trade.
Debasement. It's such a heavy word. It sounds, medieval. What does it actually mean for the average person with a 401k?
It's the fear that your money is melting. It's the belief that the dollar and other currencies like it are losing their value permanently.
Because of government debt.
Exactly. Because of massive government debt and what feels like endless money printing. When you look at the U.S. debt, the deficits, historically, the only way to pay that off has been to print more money.
Which makes every dollar that you already have
worth a little bit less.
So people were fleeing the dollar because they didn't trust it to hold its value.
They were fleeing the system entirely. Until yesterday, the prevailing mood was a deep lack of trust in U.S. institutions, a lack of trust in property rights, a fear of structural inflation. So investors wanted hard assets.
Things you can touch.
Things you can touch. Things that the Federal Reserve can't just print into existence.
Which gave us the everything rally.
Precisely. It wasn't just gold. It was silver, it was copper, it was farmland, fine art. Anything that wasn't a piece of paper promising to pay you back later. It was a fundamental rejection of the U.S. bond market and a flight into physical safety.
And then Friday, the news broke. The trigger. Donald Trump nominated Kevin Warsh as the new chair of the Federal Reserve.
The moment everything changed.
Now, I know the name Warsh. He's a familiar figure in banking circles, but he hasn't been at the Fed in years. Why does bringing this one guy back cause a $1 trillion panic?
Because Kevin Warsh represents the death of the Fed put.
Okay, the Fed put. We hear this term constantly. But let's be really precise. Does this just mean the Fed will bail us out?
Essentially, yes. For the last, 20 years, the market has operated on this hidden guarantee. If the stock market drops 20%, or if credit markets seize up, the Federal Reserve will step in. They will cut interest rates to save it.
They'll inject liquidity.
They'll be the put option that stops the losses.
Yeah.
It's the ultimate safety net.
It was the safety net.
It was. But Kevin Warsh has spent the last decade writing op-eds and giving speeches saying that this entire philosophy is dangerous. He believes that by constantly bailing out the market, the Fed creates zombies.
Zombies.
Weak companies that should fail but don't. He wants to shrink the Fed's balance sheet. He wants to stop the money printing. He hates quantitative easing.
So he's the eat your vegetables candidate for the Fed.
He's the let the forest fire burn candidate. He believes that pain is not just necessary, but it's healthy. It's what cleanses the system.
And his nomination signaled to every trader on Wall Street.
That the safety net was being cut. The mantra shifted instantly. I mean, within minutes. It went from buy everything because the Fed has our back to let it burn.
Let it burn. That's a quote we saw circulating all over financial Twitter yesterday.
Yes. The philosophy that's being attributed to this new potential approach is let the forest fire happen, let the weak companies fail, let the asset bubbles pop, then and only then you pick up the pieces and rebuild.
So if you're an investor and you're holding gold specifically because you think the Fed will print money forever,
and suddenly the guy in charge says, I'm turning off the printer.
Your entire thesis just evaporated. Poof.
In a heartbeat.
And that brings us back to that staged concept. It wasn't just the news itself. It was the positioning. You used an analogy when we were prepping for this. Something about a crowded room.
Right. Imagine a very small room, and it is absolutely packed, shoulder to shoulder with people. That room is the long gold trade. Everyone is in there. They are all betting on the exact same thing. They've been piling in for 2 years straight. It's the most crowded trade in the world.
And Kevin Warsh walks in and yells, "Fire!"
Or maybe more accurately, he walks in and just logs the cash register. The news hits, and everyone in that incredibly crowded room tries to run for the exit at the exact same time.
But the door is tiny.
The door, which is the number of buyers willing to take the other side of that trade, is microscopic. And when everyone sells and nobody buys, the price doesn't just drift down, it gaps down, it crashes. It has to fall to a price low enough to entice someone, anyone, to step in and buy.
So the stage was the overcrowding, the actor was Kevin Warsh, and the play was a tragedy for anyone holding leveraged metals.
A tragedy for the leveraged, yes. And that distinction is so important. But before we get deep into leverage, we have to talk about another analogy. You mentioned fire insurance earlier.
Right, this is the one that really clicked for me. Usually you buy gold as insurance against a fire.
Correct. Think of gold and silver like a fire insurance policy on your house. You buy it so that if the house burns down, if the economy collapses, if inflation runs wild, you're protected. You get a payout.
Makes perfect sense.
But imagine a scenario where the fire alarm goes off. Everyone smells smoke. But instead of the insurance paying out, the insurance company itself catches on fire.
Oh, wow.
Or, maybe more accurately, everyone who holds an insurance policy tries to sell that exact same policy to someone else at the exact same second while the house is still smoking.
And there are no buyers for the policy because they're too busy watching the house burn or trying to get their own policy.
Exactly. The insurance policy gold collapsed because of the market dynamics of the policy itself, not because the fire went out. The fire is still burning.
The risks are still there.
All the risks to the economy, Venezuela, supply chains, the debt, they're all still there. But the asset you bought to protect yourself suddenly became the most dangerous thing in your portfolio for about 6 hours yesterday.
That is a terrifying thought. But it explains why we saw what we saw. Let's look at the damage. I want to read some of these numbers again because they are just staggering. So January 31st, 2026, silver dropped from around $120 to, what, roughly $82?
And moving fast, it's still volatile.
That is a 30% drop in hours.
In the world of currencies or bonds, a 1% move is a big deal. A 30% move in a major commodity like silver is. It's like a nuclear detonation. It wipes out decades of price history in a single afternoon.
And gold. It dropped below 5,000 to around 4,800. Platinum had its worst single day ever. I looked at the charts, and honestly, if you removed the labels, I would have told you it was a meme coin, a volatile crypto asset, not gold, not the bedrock of finance.
And that comparison to crypto is actually really interesting because the behavior was similar. It was pure liquidation. But to understand why gold specifically got hit so hard, we have to talk about real yields.
Okay, this is a concept that always trips people up. Real yields versus nominal yields. Break it down for us as simply as possible. Why does this matter for a shiny yellow rock?
It is the single most important dial for the price of gold, period. Here's the simple version. Gold pays you nothing.
Right.
It just sits in a vault. It has no dividends, no coupon payments. It generates no income.
It's a pet rock, a very, very expensive pet rock.
Essentially, yes. Now, compare that to a U.S. government bond. Let's say a government bond pays you 5% interest. That's the nominal yield.
Okay.
But then you have to subtract inflation. If inflation is running at 2%, you're making a real yield of 3%. Your money is actually growing faster than prices are rising.
Okay. So if I can make a guaranteed 3% profit over inflation with a safe government bond, why on earth would I hold the pet rock that pays zero?
Exactly. That is the opportunity cost. Holding gold in that environment means you are giving up a guaranteed risk-free return.
But wait, hold on. I need to challenge that for a second. Because under the old administration, inflation was running hot, right? Let's say inflation was, I don't know, 6% and bonds were paying 4%. In that case, your real yield is negative 2%. You are actively losing purchasing power by holding that bond.
And in that scenario,
Gold is king. The pet rock that pays zero is better than the bond that guarantees you a loss. That's why gold went to $5,000 in the first place.
Okay, I'm with you. So what changed with the Warsh news?
When Kevin Warsh was nominated, the market immediately thought, okay, this guy is going to keep interest rates high to fight inflation, and he's actually going to succeed in bringing inflation down. So if rates stay high, let's say 5%, and he manages to crush inflation down to 2%, suddenly you have a positive real yield of 3%.
So the entire math just flipped instantaneously. The entire market pricing flipped on a dime from negative real yields forever to positive real yields are back on the menu. And if real yields are positive, holding gold becomes very expensive compared to holding bonds. Money flows out of the rock and into the bond.
But a shift in expectations, that usually causes a correction, a dip. This was a crash. This was a complete collapse. That suggests something more mechanical, something more violent was at play.
And that is where we get into leverage and margin. This is the real engine of the crash.
The speeding car analogy you mentioned earlier.
Yes. Think of leverage like driving a car at 150 miles per hour. When the road is straight, when prices are going up, it feels incredible. You get to your destination, your profit, very, very fast.
You put down $10, you control $100 worth of gold.
Exactly. Sounds great until you hit a tiny bump in the road.
And Kevin Warsh was the bump.
He was a giant pothole. When the price dipped just a little bit on the news, because of that real yield math we just discussed, the brokers who lent these traders the money got extremely nervous. They issued margin calls.
We need more cash now.
Precisely. The phone rings and it's your broker saying, your position is losing value. You need to put up more cash to cover the risk, or we are going to sell your position for you.
And imagine thousands of traders getting that phone call at the same time.
Do they have the cash? Of course not. They are fully invested, fully leveraged, so they are forced to sell the gold.
And their selling pushes the price down even further.
Which then triggers margin calls for the next group of traders who are a little less leveraged.
And they have to sell.
And down it goes. It's a cascade. It creates this vicious feedback loop where selling begets more selling. It doesn't matter what the fundamentals are. It doesn't matter if Venezuela is collapsing or supply chains are broken.
The broker doesn't care.
The broker does not care about your geopolitical thesis. The broker cares about their own solvency. They hit the sell button. End story.
That explains the speed. It's algorithmic and it's forced. But I noticed something specific in the data. Silver got absolutely hammered, way harder than gold. Why is that? Is it just because it's a smaller, thinner market?
It is smaller, which makes it inherently more volatile, but silver has a dual personality. It's schizophrenic.
How so?
On one hand, it's money. It's poor man's gold. People buy it for many of the same reasons they buy gold, as a store of value, a hedge against inflation.
Right.
But on the other hand, it's a critical industrial metal. It goes into solar panels, electronics, batteries, medical equipment.
So it actually has a job to do.
It has a job. So when the Kevin Warsh news hit, it was a brutal double whammy for silver. First, the monetary demand collapsed because of the high rates and positive real yields we just discussed.
Okay, that's hit number one.
But secondly, if Warsh is going to be hawkish and tighten the economy to fight inflation, that usually causes a recession, or at least slows the economy down significantly.
And in a recession, factories shut down, or they scale back production. They buy less silver.
Exactly. So in the same instant, silver lost its monetary premium and its industrial appeal. Plus, historically, silver is a much more speculative market. The crowded room in the silver trade was even more packed than in gold.
So the exit door was even smaller.
And the stampede was even uglier.
It's just brutal. It really highlights how these markets are all so interconnected. You pull on one thread, in this case the Fed chair nomination, and the whole sweater just unravels.
It really does. And speaking of pulling threads, we have to talk about the political drama behind this nomination.
Yeah.
Because it is not nearly as simple as Trump picked a guy.
Oh, not at all. This is where it gets really fascinating and frankly a bit confusing for me. We have Donald Trump, who famously loves low interest rates. He wants the stock market to go up. He wants cheap money.
Always has.
And yet he nominates Kevin Warsh, a man who is famous for wanting the exact opposite.
It's a complete paradox.
Why would he do that? It feels like shooting yourself in the foot, politically.
There are a few theories floating around. One of the main ones is the personal connection. Kevin Warsh isn't just a banker. His wife is Jane Lauder.
Lauder, as in the Estee Lauder Cosmetics empire.
The very same. Jane Lauder is the granddaughter of Estee Lauder, and her father, Ronald Lauder, is a very close, longtime friend of Donald Trump.
I did not know that.
Yeah, they went to school together. Ronald Lauder is a massive figure in his own right. President of the World Jewish Congress, very involved in geopolitical strategy.
Yeah.
A billionaire.
So this is a friends and family play.
It suggests that Trump prioritizes loyalty and personal relationships over, say, ideological purity. The theory goes that Trump believes he can control Warsh because of this close personal web.
He thinks he can make him do what he wants.
He might think Kevin is a hawk, but he's my hawk. I can make him cut rates when I need him to.
That is an incredibly high-stakes gamble.
It is. In fact, Trump even tweeted today, saying something to the effect of, Kevin Warsh is a winner and will cut rates without me even having to pressure him. He is trying to frame the narrative.
But the market isn't buying it.
Not yet. The market sees Warsh's 20-year public record, not his father-in-law.
But here's the wrinkle, right? It's not even a done deal. We have Senator Tillis, a Republican, threatening to block the nomination.
The Tillis blockade. This is absolutely crucial. Senator Tillis sits on the banking committee. The Republicans have a razor-thin majority. If Tillis votes no, Warsh probably doesn't get the job.
And why is Tillis angry? What's his motivation here?
He says he is defending the Fed's independence. The Trump administration has been relentlessly attacking the Fed, threatening to fire Jerome Powell, generally treating the central bank like a political arm of the White House. Tillis is basically saying, stop the attacks, guarantee the Fed's independence, or I will kill your nomination.
So we have a market crash based on a nominee who might not even get confirmed.
Welcome to 2026. The uncertainty is the only certainty. If Warsh gets blocked next week, we might see this entire crash reverse in a single hour. Or if he gets confirmed, we might see another leg down.
The market is pricing in maybe.
Which is why volatility is through the roof.
It's incredible. And while all this Western political drama is playing out, there is something really weird happening on the other side of the world. The Shanghai anomaly.
This is one of the most fascinating signals in all the noise. While silver was crashing to $80 an ounce in New York and London, the price of silver in Shanghai, China, was trading significantly higher.
And when you say significantly, how much higher are we talking?
At one point yesterday, the spread, the difference in price, was nearly $30.
$30? That's almost a 50% premium.
It is.
Wait a second, that shouldn't happen. In a global market, if silver is $80 here and $110 in China, shouldn't someone just buy it here, fly it to China, and sell it for a massive risk-free profit? That's arbitrage. That's like Econ 101.
In a perfectly free and open market, yes, that's exactly what would happen, and the price gap would close in minutes. But we don't have a perfectly free market.
China's capital controls.
Exactly. There are limits on export and import quotas.
Yeah.
You can't just move money and metal freely across that border. So the arbitrage mechanism is broken.
Okay. But what does that tell us? What's the signal?
It tells us the nature of the crash. The crash in the West was driven by paper silver, futures contracts, derivatives, the leveraged bets we talked about.
Yeah.
It was a financial panic. The price in Shanghai represents physical demand. The Chinese market is, by and large, actually holding the metal.
So the West is selling promises of silver, and the East is holding actual bars of silver.
You've got it, and the East isn't selling. This huge gap suggests that the crash is an event happening in the financial system of the West, not a sudden loss of fundamental value in the physical metal itself.
If you could teleport silver from a vault in New York to one in Shanghai.
You'd become a billionaire overnight. But you can't.
And this connects to the geopolitical angle too, right? We saw reports about Russia and China using gold as a, quote, laundromat.
Gold laundromat is a great term for it. Since the sanctions and the freezing of dollar assets a few years back, Russia and China have been aggressively trying to move away from the dollar system.
De-dollarization.
That's the one. Russia mines gold, they send it to China. Shipments are reportedly up 800%. China processes it, and it either enters the global market or, more likely, sits in Chinese state reserves.
They are building a parallel financial system, with gold as one of its pillars.
They are. And this is what you'd call structural buying.
Hmm.
Central banks and state actors, they buy gold for strategic reasons. They don't care if Kevin Warsh is the Fed chair. They aren't trading.
They're accumulating.
Exactly. They are buying for the next 20 years, not the next 20 minutes.
So we have this incredible tension. The structural buyers, China, Russia, other central banks, they provide a kind of floor under the price. And then the speculative buyers, the hedge funds, the retail traders, they provide the ceiling and all the volatility.
And yesterday, the speculators got completely wiped out. But the structural buyers are likely still there, quietly accumulating on the dip.
And that raises the big questions, the things we don't know yet. We call these knowledge gaps. These are the things that you, the listener, really need to watch this week.
Absolutely.
Okay, let's list them out. What is the first and maybe biggest knowledge gap?
It has to be the Warsh pivot. Will Kevin Warsh actually be the hawk that everyone fears he is? Or will he bow to the inevitable political pressure from Trump?
His history says hawk.
His entire public record screams hawk. But his new boss says dove. The market is pricing him today as a hawk. If he comes out in his confirmation hearing and says, actually, you know what, I think rates are a bit too high, the market has this completely, utterly wrong.
Right. If he folds, the entire crash was a mistake based on a bad assumption. Okay, knowledge gap number 2.
The physical squeeze. Can the West keep paper prices this low $80 silver when China is willing to pay 50% more for the real thing? Eventually, physical metal starts to drain from the West and flow to the East.
People will find a way around the controls if the profit is big enough.
They will. And if the vaults in London and New York start getting empty because everyone is shipping metal to Asia to capture that premium, the paper price has to explode upwards to stop the bleeding. It has to reconnect with physical reality.
That would be a supply shock on top of a financial shock. And number 3.
Real yields. I know we've said it, but I cannot stress this enough. If you want to know where gold goes tomorrow, don't look at the news headlines. Don't listen to the talking heads. Look at real yields.
Interest rates minus inflation.
It is the compass. If that number is going up, gold probably goes down. If that number starts to fall, gold will rally. It is that simple.
So looking forward then, we had the crash. The system is clearly shaken. What are the broader implications for the future? We talked about this let it burn philosophy.
It seems to be the defining theme of this incoming administration, or at least that's the market's interpretation of it. For a long time, really since 2008, the unspoken rule was that the government would not allow significant pain in the financial markets.
They'd always step in, the Fed put.
Right. If the stock market fell, they fixed it. Now, we are looking at a potential regime change where volatility is allowed, where bad businesses are actually allowed to fail, where leverage gets punished instead of rewarded.
That sounds healthy in theory, like a forest fire clearing out the dead wood. But it sounds incredibly painful in practice.
Extremely painful. It means we might see 20% drops in the stock market that don't get an immediate rescue package from the Fed. It means the training wheels are off the bicycle.
And what does all this mean for the U.S. dollar? Because, interestingly, while gold and silver crashed, the dollar actually rallied hard.
Yeah, the dollar rallied because of that mechanical process we discussed, the margin calls. When people need cash to pay their debts, they sell whatever they can, gold, stocks, anything, and they buy dollars.
It's a dash for cash.
It's a liquidity event. In a true crisis, the dollar is still the cleanest dirty shirt in the laundry hamper.
So short term, King Dollar is back.
Short term, yes.
Yeah.
But long term, have any of the fundamental issues changed? The U.S. still has a massive unpayable amount of debt. The trust issues that started the debasement trade in the first place are still there. We just put out the fire in the gold market, but the house is still built on a foundation of debt.
That's the key, isn't it? The narrative shifted for a day, but the underlying math hasn't changed at all.
The math never changes, just the sentiment.
So what should we be watching on Monday morning? The markets open in? Well, depending on when you're listening to this, they might be opening very soon.
3 main things. First, follow through. Does the selling stop here? Do we see a dead cat bounce? A small, weak recovery that's followed by another drop? Or do real value investors step in and say, wow, gold at 4,800 is a steal?
Okay, what's number 2?
Second, watch the silver versus gold divergence. If silver keeps dropping while gold stabilizes or even rises, that is a huge signal. It tells you the market is terrified of an industrial recession. It's the industrial fear taking over from the monetary fear.
And
The confirmations. Watch Senator Tillis. Watch the Senate Banking Committee. If the Warsh nomination hits a serious wall, the entire premise of this crash begins to unravel very, very quickly.
It's going to be a wild week. Thinking about all of this, we started this whole deep dive talking about trust. The debasement trade was all about losing trust in the dollar and the system.
Yes.
But what happened yesterday? It almost feels like the market decided to trust a single person, Kevin Warsh, to fix the system more than it trusted gold to save it.
That's a very profound way to put it. But I would add one last nuance to that. Prices are set at the margin.
Explain that one last time for the people in the back.
It means the value of your house doesn't change because you love living in it. It changes because your neighbor, in a panic, sold his at 3 in the morning for half price. Yesterday, the neighbors panicked. They sold their insurance policy, not because the fire risk went away, but because the premium, the opportunity cost, got too expensive for them to hold.
But the house is still there.
The house is still there. And the fire risk is still there. The foundation of the bull case for gold, the physical scarcity, the limited supply, thousands of years of history as money, that all remains. The price you see on the screen changed because of leverage and fear. But an ounce of gold is still an ounce of gold.
That really is the key takeaway, isn't it? Don't just look at the price tag. Look at who is selling and why they're selling. Are they selling because the asset is suddenly bad? Or are they selling because they have a margin clerk screaming at them for cash?
It's almost always the latter. And that right there is where the opportunity usually hides.
Well, I think I'm going to go check the futures markets one more time, even though I know I probably shouldn't.
Stay calm and watch the real yields.
Stay curious, everyone, and seriously, watch those real yields. We'll see you in the next deep dive.
Goodbye for now.